This is an investment company with REIT status, and we invest in UK commercial real estate. Before I provide some detail on the specific investment case for SREIT, and also some interesting updates on how we're applying our strategy to our portfolio, I thought it'd be helpful to set the scene in terms of the macro background insofar as it relates to the valuation of real estate assets. So first I'm going to touch on interest rates and gilt rates. So the valuation of real estate is impacted by interest rates and interest rate swaps and gilt rates. So just for some background, so since the tariff and tax war rhetoric that was coming out of the US election in the second half of last year, and also the release of the Labour budget in October last year, where a higher spend and higher tax strategy was communicated to the public, there has been volatility in gilt rates. So if we look at the 10-year gilt rate, the yield on that increased from 3.8% in July last year up to 4.9% earlier this year. So pretty material increase there. It's since moderated down to 4.6%. But higher gilt rates can mean higher borrowing costs for the government, and that can constrain their ability to pursue their investment program. And that in turn can drag on economic growth and erode expected tax revenues. And in terms of the future path of interest rates, so the way the market has reacted to these developments has been to essentially show a higher for longer trajectory. So for example, if you look at the chart on the left-hand side, the market's now only pricing in 225 basis points rate cuts through to September, whereas on the 30th of October, so immediately prior to the budget being announced, the market was expecting rates to reach 4% by the 8th of May, whereas now the trajectory is expecting 4.5% at that point. So we think that a higher yielding strategy could be beneficial in such a sort of higher for longer interest rate environment. And I'll explain how SREIT sits and fits in this regard in some slides that we're going to turn to shortly. Briefly on the chart on the right hand side, you can see that we are forecasting the 10-year gilt to tighten to 4% from the current level of 4.6%, which was what it was actually at the end of 2024, as we move through the current interest rate cutting cycle. So you can see that green line kind of sits around 4% in the forecast period. And we also believe that the property initial yield has peaked, and you can see that by the red line. So it kind of increased from 4 to 5% in this chart, and has been maintained at around 5% in the forward-looking forecast. And then the result of that is you can see the blue bar. So we've got quite a tight yield spread there between the property yield and the 10-year gilt yield. And that is tighter than the period following the GFC through to 2021. We think that's justified because, you know, post-GFC, there was a pretty unique period where you had ultra loose monetary policy, including quantitative easing. So we think that green line, that gilt yield, was actually sort of artificially lower. So that's why we're comfortable expecting a tighter spread looking forwards, particularly given our expectation of continued rental growth as well. There has been an interest rate cutting cycle. So if we just recap that, interest rates were 0.1% at the end of 2021, and through 22 and 23 they were increased to 5.25%. That has resulted in a substantial decline in average real estate values. So the peak to trough decline, so the peak being June 22, the trough September 24, was around 25% for real estate on average. So a really material decline through the cycle. But what we've seen in the past few months has been, you know, a contrast to that. So we've seen a couple of interest rate cuts, and you can see in the chart that you're starting to see the capital values trend upwards marginally. Now, the exception is offices, where there continues to be some uncertainty with work from home and concerns around obsolescence. So you can see that dark green line, it hasn't started trending up yet, but it has stabilized. Potentially at a turning point. Now, given values have declined 25%, we think that, you know, now might be an interesting time to invest into real estate, particularly given, not only have values stabilised, are started to recover, and S-REIT could be an attractive option there. Now, another important point to note is whilst we did see these valuation declines over the past 2 or 3 years, there has continued to be attractive rental growth through that period. And that rental growth has been markedly stronger than coming out of past downturns. So coming out of the GFC, coming out of the dot-com bubble, the rental growth has been much stronger, particularly for structurally supported sectors such as industrial and such as retail warehouse, where S-REIT is allocated 62% of its portfolio value. And as I said before, we do expect that rental growth to continue. Looking at investment volumes, so what these charts show is the value of real estate that's been bought and sold in the time period shown. And the key points to take away are that 2023 and 2024 were particularly low in terms of volume. Clearly, as values are coming down, investors were biding their time. But interestingly, in Q4 24, there was a 20% increase in volumes compared to Q3 24. We also saw several portfolios trade to private equity. So there were some investment trusts that were acquired by private equity in recent months. And anecdotally, our teams are seeing more sources of capital showing firm interest in UK real estate opportunities following that repricing we looked at on the previous slide. In addition, there's a pretty steady stream of transactions from defined benefit pension funds as they de-risking their portfolios. Now they're fully funded. And as asset owners are having to refinance their debt into higher interest rates, we're seeing more sort of sales as a result of that. But we don't expect there to be many distressed sales like there were out of the crisis. Leverage was much lower in the system this time round, and banks are looking to work with borrowers where required. Now, the good thing about this steady stream of transactions is that it provides valuers with evidence. So when they're looking to value REIT portfolios, they're obviously basing it on transactions that have occurred recently for similar assets. And as we see more of these transactions occurring, it just gives them evidence to base their valuations on, and that can give investors confidence in the valuations and the NAVs, and that may give them the confidence to come back into the real estate sector. Turning to slide 7 and bringing some of these factors together, we show our forecast returns for real estate for the coming years. Now, the first thing to note is these will, of course, be wrong because they are forecasts and the actual outcome will be different. But what you can see is from 25 to 28, we expect above average total returns from real estate following that 25% repricing. This can be rationalized as a 5% income return, plus 2 to 3% rental growth, plus 1 to 2% capital growth from some slight yield compression as those interest rates come down. Again, this chart speaks to an opportunity to potentially enter real estate at a particularly compelling time. As the chart shows, we're looking at 8 to 10% per annum total returns over the next 4 years. With that background in mind, what is the investment case for S-REIT today? Now, first, we're allocated to the high growth sectors, so sectors we believe will be high growth, long-term industrial estates, retail warehouses where there's really strong occupier demand and a lack of supply coming through due to high construction costs. We also have a very high reversionary yield, and I'll explain what reversionary yield is shortly, but at 8.5%, it's well in excess of the benchmark at 6.1%. Secondly, today we've got a dividend yield of around 7.6%. That's fully covered by earnings, and we think that's an attractive yield, particularly in this higher for longer interest rate environment. Third, we've got a really robust balance sheet, and that gives us really good visibility on earnings going forward. So if we are able to grow our rents and achieve that reversion, we should be able to keep a lid on our interest costs, and also be able to forecast them looking forwards, which helps us then move the dividend on in the future. The average interest cost at the moment is 3.5%. 89% of our drawn debt is either fixed or capped, and we have more than 9 years average maturity on our debt, and we'll touch on our balance sheet in a bit more detail shortly. Fourth point, so the current share price, you can buy into the company at a 23% discount to NAV. Given the recovery in valuations and the total returns I articulated earlier, given the earnings growth potential as we look to achieve that reversionary yield, and also our evolving shareholder register, all give really compelling reasons as to why now might be a good time to invest in the company. Now, just to give you some background on the shareholder register, we've had some new wealth managers join the register over the last year or so, and in the 6-month period ended 30th of September last year, we reported that the number of shares held by direct investors on the AJ Bell platform, Interactive Investor and Hargreaves Lansdown increased by 24%. So thank you for your support there for those who have supported us. Fifth point and final point is we do have a very clear sustainability improvement strategy. We are executing that strategy. We're looking to manufacture the green premium to generate income growth and capital growth for our shareholders, and we'll have some examples on that in the coming slides. This slide, we set out some important sort of stats on the company. I won't go over all of them. I've touched on the sector allocations previously. Just to point out the performance in the bottom right-hand corner, that's portfolio level performance versus our benchmark. We're outperforming over all the periods shown, and we also were pretty pleased to win a MSCI Performance Award. So we got a 10-year award, so a really good award to win there. So we won the highest 10-year risk-adjusted relative return for all UK and continental European funds, with a total return of 8.45% per annum to December 23. Slide 11, I'd just like to give you a flavour of some of the assets that we hold in the portfolio. So I mentioned that high industrial allocation, and in the left-hand column, you can see our two largest industrial exposures by value. Again, industrial really benefiting from that demand in e-commerce, and as companies look to strengthen their supply chains as we kind of exit this globalization era. In the central column, you see our two largest office exposures. The top asset you can see there is located in Bloomsbury, so just close to Tottenham Court Road, Crossrail Station. It's occupied by the University of Law and is used as a university campus. University of Law are our largest tenant, and we'll see that shortly. This asset's benefited from really strong rental growth in the area, and we executed a really good re-gear with the tenant last year. The right-hand column shows our two largest retail exposures. The asset you can see in the top photo is St John's Retail Park in Bedford. This is the catchment dominant scheme in the area, and it's anchored by Lidl. And, as I've said, retail warehouses are a really interesting sector at the moment. Moving to strategy. So as a reminder, or perhaps as new news to some of you, we did update our investment objective last year. We're now required to make a meaningful improvement in the sustainability performance of assets during the period that we own them. To measure ourselves against that objective, we have two KPIs in our investment policy: an asset level KPI using our proprietary ESG scorecard, and a portfolio level KPI based on our net zero carbon pathway. The key reason for making these changes is we believe that a focused sustainability will help us to generate an enhanced total return for our shareholders. In short, we think we can profitably manufacture the green premium. On the right hand side is a proof of concept. This is an asset we acquired in December 2020. It's Stanley Green Trading Estate in Manchester. Since acquisition, we generated a total return of 17% per annum. That compares favourably to the industrial benchmark at around 7% per annum. And we're able to achieve that by developing 11 new units on a 3-acre plot of land on the estate. We made a conscious decision to develop those units to the highest sustainability performance, so the EPCA Plus, BREEAM Excellent. And as a result, we've been able to achieve excellent rents on that new site. So they're 39% higher than the existing site, the brown older units for similar size units. And we've also been able to attract really good tenants to the site, such as Siemens. Not only do we get higher rents, but we've also got a keener yield applied to the units by the valuer. So the yield applied to the new green units is 5.35%, compared to 6.5% to 7% for the older brown units. And as we're making progress with this strategy, we're starting to see these higher rents come through elsewhere. And I'd like to just briefly touch on a couple of examples on slide 14. So on the left-hand side is another one of our retail parks. This is Churchill Way West in Salisbury. There's 3 units there, and you can see them on the left-hand side of the image in the top left. So they're to the left of the Waitrose. They were occupied by Sports Direct, HomeSense and Smith's Toys. HomeSense and Smith's Toys are vacating the site. We've negotiated a deal with Lidl to bring them to the site. So a really strong tenant coming to the site. They're taking a 25-year lease with a break at year 20. So that's fantastic. And the rents passing, so the previous passing rents for the old tenants was around £13 per square foot. The rent that Lidl will be paying is close to £20 per square foot. But the reason they are willing to pay that rent is because of the combined landlord and tenant works to bring that EPC up to an A. There's going to be PVs on the roof. There's going to be EV charging points in the car park. And it's going to be a really fantastic scheme when that's all done. It is subject to planning, which we're in the process of trying to obtain now. On the right-hand side, another multi-let industrial estate. This one is 3 units in Swindon on an established industrial estate there in Swindon. What we had there were 3 units. They all came back to us around 2 years ago. We let one of them immediately at a rent of £7.26 per square foot. The other 2, we undertook a significant refurbishment to bring the EPCs from a D and a C respectively to a B. Again, we've got PVs on the roof. We've got EV chargers in the car park. And since we completed that refurbishment, we have let one of the units at a rent of £8.25 per square foot. Now, the previous passing rent on that unit was around £6, so we've increased the rent by more than a third there. So another example of these sustainability improvements enabling us to push the rents on and grow the income for the fund. The final unit's in the market, and we're hoping to achieve the same level of rent as the unit recently let. Sometimes with our assets, we do seek change of use. These are 2 examples. So on the left-hand side is another multi-let industrial estate. Outlined in green on the bottom image, you can see a 14-acre site. It's currently got a value of around £9 million. We're looking to obtain residential planning, so for build to rent or build to sell. And that site with planning could have a market value of £10 to £19 million. So another active management example of adding value to our assets. On the right-hand side, we show Hayward House, which is an office in Cardiff. Really strong student demand in Cardiff, and we're in the process of seeking planning permission for a change of use to purpose-built student accommodation, where we could build a tower up to 28 stories, which would increase the value of the asset or the site from 4.15 million to potentially 7 to 10 million. Looking at the balance sheet, I mentioned it's a competitive advantage, and it's really underpinned by the Candid Life term loan, and you can see that in the blue bar, so the bottom left-hand corner of the chart. £129.6 million fully drawn at an average fixed interest cost of 2.5%. So really attractive in today's environment. The average maturity of that loan is 11.5 years, and the value of that loan isn't reflected in the NAV, and it's close to £20 million. We do have an RCF. It's partially drawn and partially capped, and that the capped element is the red box, the uncapped element is the green box. And as a result of those drawn debt, the net LTV is 37.3%. As I said earlier, the average interest cost is 3.5%, and the average maturity is 9.1 years. So a really strong balance sheet in our view that is a competitive advantage. Briefly on the portfolio, on the left-hand side, we're drawing out some key stats. So the number of properties and number of tenants. So 39 properties, more than 300 tenants. So a really granular portfolio that distributes risk across, lots of tenants and assets. And I've also highlighted the high income profile of the assets. So net initial yield 6.1%, net reversion yield of 8.5%. Now, what that reversion yield means is the market value of the rents is ahead of the current passing rent. So the current rent we're getting from our tenants is below the market. And that's because leases last for 5, 10, 15, maybe longer years. Now, as rent reviews come around, as re-gears occur, and as leases expire and we bring new tenants in, we should be able to capture that reversion. Now, that difference in rent, so the passing rent at the period end was 30.1 million. The estimated rental value is 39.4 million. So that's an uptick of £9 million. To put that into context, the annual dividend is £17 million. So if we are able to capture some of that 9 million, it could give potential for us to move that dividend on in the future. And on the right hand side, we show the sector splits, which I spoke to before. Tenants, this is our 15 largest tenants. There are some household names on this list, such as Siemens, Lidl, Balfour Beatty, Premier Inn. We're really happy with this list. And as you'll see, the majority of them represent, well, all bar one are less than 4.5% of the portfolio. So that speaks to that granularity and that spread of risk. This chart breaks down our pathway to achieve the reversion, and I'll leave that with you to read because the presentation being provided to you, but you can see that £9 million uptick there and the steps we're going to take to try to achieve that, noting there will always be some vacant space. We have made some disposals recently, or a disposal recently. We sold Howard House in Bedford for 1.475 million, which is 23% ahead of the book value at the end of September, which are the latest results we've released. So really attractive outcome there. And we've got other assets in the market. For example, Truro, just shown in the image below, a couple of retail units that we are looking to sell. We can also recycle capital. So if we can sell at lower yields of 5.5 to 6%, then initially pay down the RCF. So the uncapped RCF is costing 6.6%. That will be immediately accretive. And then we look to reinvest, so draw back down on the RCF into attractive opportunities. Now assets have repriced at 7% or higher yields to grow earnings. And then final point, we're always looking to control our costs, and we're aiming to reduce our void from 11.2% down to 8% over time. The reason it's a bit higher is we've completed developments recently at Stanley Green, at Stacey Bushes, Holland Lane. We did a similar scheme to Stanley Green, and also at Stirling Court we have that void unit. So conscious of time, and just to wrap up from me, so UK real estate values are recovering. It's supported by limited development, positive rental growth, lower inflation, and the beginning of an interest rate cutting cycle. Our underlying portfolio continues to offer strong relative performance versus benchmark of peers. There's significant potential to drive earnings growth through our high portfolio reversion. And we've got a really attractive balance sheet. And finally, our formalised strategy focused on sustainability, we think will help us enhance total returns in the long term.